Hello and very good morning to all our dear students. I hope you're doing fine and doing absolutely great. So today we are on the fifth class of the Forex and I warmly welcome all of you to our VCC classes conducted by ICA Board of Studies Department. Okay. So before we proceed further, just wanted to tell you that today will be one of your important classes. Important classes means that if I tell you about the four classes, the first in the second class was very conceptual. Then from the third class we started doing the questions which are frequently asked in the examination. Today we will be covering up one of the concepts which are one of the favorite topics of the examiner. But as I always been saying, I'm not an examiner, okay? I am not even connected with the examination team. It's just that we guys share our experiences with you so that you can prepare well for your examination and clear the paper with good marks. Okay, so what we have done till now, let me just tell you, okay, just to give you a recap or you can say a revision of what the things we've already done. Okay, just one sec, huh? Yeah. Okay. Okay. So as you can see, we have started with the concept of forward contract. Okay, forward contract simply basically means that the obligation of one party to fulfill the contract. Okay, so generally there are two parties. I mean, although there are multiple parties which are involved in this forward contract, but that happens only when things doesn't happen on a normalized basis. What did I say? Just say carefully. I'm saying generally only two parties are involved. Either the question that would be given to you, beta, it could be either that you are a banker, okay, or you are a customer. Okay, so if you are a customer, so either you will be an exporter or you will be an importer. Obviously, you can't be any other person. Import exporter means either you will be buying the foreign currency or selling the foreign currency. I mean, these are the two possibilities. Again, you just can't go to the bank and said, yes, sir, what do you want? Nothing. I was just free at home. I just wanted to know what are the rates which are going on. I mean, this doesn't happen. I was preparing for SFM. I just got little bored. I thought, let's have a walk on the bank. It doesn't happen. So you are going to the bank only for two purposes, either buying the foreign currency or selling the foreign currency. And on the contrary, the bank is either buying the foreign currency from you or they selling a foreign currency to you. I mean, these are the only things which are happening. But just in case the things doesn't happen in a normalized manner, okay, means there are either some early delivery, okay, some cancellations, okay, some extensions. So we always have to make certain adjustments to our original contract, okay, because as I told you, when the bank is taking any position from you, either to buy the foreign currency or sell you the foreign currency, they take a position with the interbank market. Okay, they take a position with the interbank market, so that they do not put themselves into a uncovered or a naked position. They always cover their position. And if you are doing a transaction which is happening earlier, then the bank has to involve some more people and give you the deliverable, okay, the one which you require. Okay, guys. So this is what till as of now. So what we'll be covering up today, we'll be covering the forward contract today. You have any doubts, you can just ask me. Should I refresh the this thing? Okay, so no questions, I think, as of now. Okay, fine. So So let's start now. Okay. So beta, what basically is there in your course? Number one is the delivery. So it could be a possibility that you are delivering the things on due date. Okay. So let's say this is a bank. Okay. This is a bank and you are a customer. Okay. This is you. You want to buy $1,000 US dollars. Okay. And the bank will be selling you on the due date. So when you are buying a 1,000 US dollars, not today, maybe after 1 month, and you contract that rate at the rate of, let's say, 75.15. So what happens on due date? Nothing technical happens. You go to the bank and say, okay, this is the due date, and you buy at the contracted rate. So there you don't find any technicality. Where it is important from the examination is what we had discussed in the last class. I will just give you a 5 minutes recap so that we can proceed further. Okay. What was the thing was the concept of early delivery. Okay. The concept of early delivery means that you made a contract for, let's say, 3 months. Okay. This is 0, 1, 2, and 3. You promise them that you will be coming after 3 months to buy this $1,000. But due to some reason, you came little early, let's say in 2 months earlier. Then the bank could face a problem, okay? Because they have already made an adjustment with the interbank. If they will be selling you, they want to buy with some other bank, okay? Some interbank. So when you are coming after 2 months, the rate could be different what you had contracted for, okay? I'll just explain you what I meant to say because this I've already covered in the last class. So I would not like to spend very bigger time on that because I know you guys have understood. Okay. I'll give you a glimpse again. Okay. So let's say this is a bank. Okay. And this is you. Okay. So let's name it as a ICICI Bank. Okay. ICICI Bank. You want to buy what? You want to buy a $1 lakh, okay, 3 months at the rate of 75.15. So you want to buy. So what you will do is if you are buying, the bank will be selling you. If you are buying, the bank will be selling you. So they will be doing a sale transaction, okay, sell at 75.15. Because in the examination question, it is very important for you to understand, judge that what is the examiner's requirement. So at the same time, the banks carry out this transaction with another interbank. Okay, let's say SBI. Okay, and if they are selling you at 75.15, they will make an arrangement that they buy at 75, exactly 75. So 75 they will buy and 75.15 they will sell. So it's a very simple thing because the bank is making a 15 paisa profit in between. So that's very simple. Nothing much. Now, the thing is that if you're coming after 2 months, earlier than your contracted date, okay, earlier than your contracted date, then bank faces the problem. Firstly, a lot of students think that they will not get the delivery. No. Anytime you will come, the delivery of the dollars you will get. But the other thing is you might have to pay the cancellation charges, okay, or you can say the this swap differences. Sorry, cancellation charges will come a little later. You have to pay the swap differences. Okay, so what is that? When you come after 2 months, the bank will look at the spot rates. Okay, spot rates. So let's say the rates are 75.25 and 75.35. Okay, bid and ask. So the dollars which they want to sell it to you after 3 months, they can sell you at what rate? At the current spot rate. So the rate at which they will sell you, that will remain same. इसमें exam में you don't have to change it anytime. This contracted rate will always remain same. This will never change, whether it is a delivery, whether it is an extension, whether it is a cancellation. This rate will not change. Okay, as per the new amended rules. If you are from the old course and now you have shifted from the new course, then you should know all these amendments. Otherwise, you might lose, marks in the exam. Okay, so this will remain same. They will sell you the dollars at this rate. Why? Because what happens is that if the bank wants to sell you, they will buy the dollars from somewhere. Okay, so they will buy the dollars from somewhere. So they will take the rate at which they will be buying the dollars. Okay, so they can't take this rate because this is the bank's buying rate. Okay, so if they are buying, the other bank, which is the bank, this bank. Okay, so let's take is at Bank of Maharashtra. So they went to Bank of Maharashtra and said, I want to buy the dollars so that I can deliver it to you. Okay, this is you. This. They want to buy the dollars so that they can deliver it to you. So he said, okay, you want to buy. If you will be buying, I will be selling. If ICICI wants to buy, Bank of Maharashtra will be selling and they will be selling at this price. Okay, so they will buy at 75.35 and they will deliver you at 75.1. Here, they would say, okay, this transaction get over. They say, what we will do for these dollars, the dollars that we will get after 3 months, okay, I mean, which they were supposed to get after 3 months. Now at this scenario, they will get after 1 month. So uska kya karenge? What they will do for that? They would say, okay, tell me 1 month forward rate. Okay, so let's say they say 75.20 and 75.40. What's taken? He said the dollars which I will get, from SBI, after 1 month, I will keep it for selling. Okay, I will keep it to you for selling. The Bank of Maharashtra, I will get the dollars from SBI, okay, and I will make it sell it to the Bank of Maharashtra. So at what price I will be selling? If I'm selling, the bank is buying, the bank will buy at 75.20. So my swap difference will be the difference between this value and this value. This I've already taught you in the last class. Okay, just in case you missed that class, you will have to revise that concept that we studied in the last class. And this is the swap difference. Okay, and the difference between this and this will determine your interest on cash outflow, outlay, or inflow. So any benefit that will be there to the customer, it will be passed on to him, and any loss that the bank has incurred, they will be charging from. So this is what we have done in the last class till now. You have any doubts, please tell me. Okay, I think I have by mistake closed this. Just 1 second. Okay. Oh. Okay. Final question, right? Okay, guys, so any doubts? We are just moving on to the next one. Just hold your breath. I am not able to see the underscore sign. Okay, where is the underscore sign? Okay, admin. Yeah, actually, by mistake, I just closed it. Okay. Okay, so guys, you have any questions, you can ask me without any hesitation. So today we are moving on to the next one. Okay, no questions as of now. Okay, so we are moving on to the next one now, which we left in the last class. Okay, is called as the late delivery. So what we have done till now, let me just explain you quickly. The delivery has three components. Number one, on due date. Okay, and number two, before due date. Okay, or you can say the concept of early delivery. So this question has been coming in the exam a lot of time. I don't know in your attempt it will come or not, but I know it's quite important. And this is late delivery. Okay, late delivery. So there the concept of automatic cancellations apply. Okay, so when you come after the due date, okay, just listen to that carefully. If you come after the due date, okay, so the bank wait only till 3 days. Okay, the bank wait till 3 days. And if you don't come within 3 days, that leads to automatic cancellation of that. So besides paying the swap charges and interest, you are also supposed to pay the concept of exchange differences. Okay, so what is that? We will be covering up in after some time. Nothing to worry. Okay, guys, I hope this is clear. So swap charges, I've already explained you how this is calculated. Interest, you already know how this is calculated. The exchange differences, the concept I will explain you once we'll complete this whole 3 topics, which is delivery, cancellations, and the exchange. Okay, guys, clear? Now we are coming to the second part, which is called as the concept of cancellations. Very, very important. Again, cancellation will also be on various grounds, on due date, okay, before due date, okay, and after due date. Okay, so the provisions of automatic cancellations I will be explaining you. You don't need to worry that I have not covered much. I will be covering that for sure. Okay, so this is quite important part. So you need to be very, very much thorough on understanding what this basically is. Okay, so I hope you have the assignments with you. Okay, beta cancellation on the due date. Okay, what does this basically means? Okay, let's first understand what is that concept. Okay, any doubts still here? Okay, so on the due date, what happens is you are a banker and there is one customer. The question can come where you will be made as a customer or you will be made as a banker. So you have to think in that way. The bank would be selling, let's take an example, 25,000 Swiss francs. Okay, at the rate 65.345. Let's take an example. Okay, so you are getting my point. The bank is selling and the customer is buying. This is very important from the examination to understand the requirement so that it becomes quite easy. So the banker is selling, okay, and the customer is buying. So if he is selling, what would this rate be? Bid rate or ask rate? Sir, obviously if he is selling, it will be a ask rate, right? But sir, why are you telling us? I will tell you the reason. Okay, okay. So can I clear all this and we can have that? So now we are doing the concept of cancellation, and the A part, cancel on due date. Just if you are not a spectator, you are making notes, so please write those notes very, very carefully, whatever I am writing. Although these things are given in your study material, but this will form part of your curriculum once you are revising the concept. Okay, cancel on the due date means You said after 3 months I will come and buy 25,000 Swiss franc. You came on the due date and you said, I don't want these Swiss francs anymore. Corona is going on, new variant Omicron has come, so I am not sure whether this transaction will take place, so I want to cancel it. You see, he said, you want to extend it? He said, no, no, just basic cancellation. He said, okay, fine. He said, if you come on the due date to cancel a contract, okay, you will have to pay us the cancellation charge. Okay, you will have to pay us the cancellation charge. Okay, there could be flat charges also in the examination question, but that is simple thing. That's not very technical. You have to add 100, 500 rupees. That's okay. Cancellation charges you will have to pay. Now the thing is, how do you calculate it? Okay, it is calculated as, okay, the difference between, please be attentive, contracted rate and cancellation rate. Okay, understand very carefully. We have a lot of time. Okay, we are not in any sort of hurry. Okay, number one, cancel on the due date means everything is happening within the due date. So what is the difference between due date and after due date? See beta, if you are coming on time, okay, if you are coming on time, any profit made by the customer, listen carefully, this you have done in the last class. If you are coming on time, on the due date or before the due date, okay, on the due date or before the due date, any profit that you make, okay, just in case, any profit that you make, you can get that profit from the bank because you are coming on the due date. This you have to remember always in the exam. And if you're coming after the due date, whether even 1 day late, even if, okay, even 1 day late, on the due date means it was, today is, let's say 24th December, it was expiring and you came in the banking hours. 6 o'clock is what the bank closes and you came before 6 o'clock, said I want to cancel this contract. Okay, fine. Let's do the calculation, and if will be any profit, we will give it to you. And any loss, we will charge for. Okay, but if you're coming after the due date, okay, giving a excuse, I came yesterday, I did not find the parking outside your bank, any profit you will not be eligible to get that. Clear? Point is clear? Okay. Now the cancellation charges, how does this calculation is carried out? Calculation charges means it is calculated on difference between contracted rate. Sir, what does contracted rate mean? Means the original contract price at which it was done. I give you example 65.345. We'll continue with that. Don't worry. Okay, this is the original contract. Now what, sir, what is the cancellation rate, sir? We don't know that. But this is the, write carefully, reverse action of original contract. So this is very tough. No, this is not at all tough if you play very safe even from the starting. Sir, what does that mean? I'll tell you. See, what is the example did I quote? I said this is a bank. Okay, this is the customer. The bank is selling what? 25,000 Swiss francs at the rate of 65.345. If he's selling, what is the rate that we applied? Bid rate or ask rate? Ask your heart. If the bank is selling, okay, if the bank is selling something, they must have done the ask rate. Is it yes or no? Okay, so when they cancel it, the reverse action of the original contract. Okay, if they apply the ask rate, okay, then they will take up the spot rate. Okay, whatever it is, let's take an example 65.29 and 2975. Okay, so to cancel this contract, they will sell to the customer at this rate and they will buy from the customer at this rate, and any loss or profit shall be charged to the customer. I mean, loss will be charged, profit will be given. Is it clear? Sir, little bit, we are not very confident. This is what is coming from your heart. Okay. Have you written this or not? Okay. If you want to be a master, you have to be very, very sure that this concept is clear. I just don't want to rush it. I mean, tons of thanks to Board of Studies that they did not ask me that how many classes do you want. I requested them this much amount of classes I want. I'm just so thankful to them. Okay, so we are not in a hurry. Please understand this. Okay, cancellation charges means he's coming on the due date, and it is calculated difference between contracted and cancellation, that is charged or paid to the customer. Sir, one thing I want to ask, beta. Sir, am I supposed to remember all these things? Obviously, beta. Sometimes there are times when we can apply common sense, logic in SFM. I'm talking about the all chapter. I'm not talking about only Forex. I'm talking about the first chapter since risk management, the VAR, to the last chapter, that is merger and acquisition, to the last concept as well. Okay. So I'm not saying that you can't apply the logic. You can apply the logic in SFM. Certainly, but some things you have to learn, and this is one of them. Okay. Written. Okay. I'm just rubbing all this. Now understand what I was trying to tell. Okay. Yes, sir. But this is a bank. Okay, this is a customer. He is selling Swiss franc 25,000. 3 months ka rate is 65.345. So they are selling it. It must be the ask rate. Okay. He said this is 0, 1, 2, and 3. On the third month last day, when this contract ended, the customer says, I want to cancel the contract. Corona is going on. I just don't want to, take a chance, take a panga on that. I said, okay, fine, not a problem. The original contract, okay, the contracted rate was this, and it was a ask rate. Sir, why are you stressing all of this again and again? Beta, this example, the bank is selling. It could be the thing that bank could be buying. Okay? When the bank buys, they take the bid rate. And when the bank is selling, they take the ask rate. This is very common sense, which we have studied in the first and second class. Okay? Now he said, bank said, okay, not a problem, sir. Sir or ma'am, you want to cancel it? Not a problem. Let's look at the spot rate, sir. I said, okay, fine. The spot rates are going on as 65.29 and 2975. Okay, per Swiss franc. Although that's not a rate, but just for understanding purpose. Okay, okay, sir. And this tells you that there is a spot rate. Okay, this was for, let's say, January. Okay, this was for March. Okay. Okay, January, May, 1st January se it started, 31st March you came. Spot rate for April, let's say it is 3,000 and 3,100. Spot rate for May, 6,000 and 6,100. Sir, what is this? This the examiner can give you to confuse you. Okay? Okay, sir. Sir, will it be used? Yes, it will be used ahead. So you want to know if I'm cancelling on the due date, these rates are irrelevant. Okay, sir. Fine, fine. How do we have to make the presentation? Very, very simple. Okay. Now, calculation of the cancellation charges. Now, to cancel it, The bank was selling. Okay, okay. Now the bank to buy. Okay, the bank was selling at this price. Okay, now the bank will buy at this price, which is 65.345. Sir, what does this mean? Listen carefully, apply logic, beta. If the bank is selling, okay, the customer is buying. Okay, originally, the bank was selling and the customer was buying. Now says you want to cancel the contract. Now reverse the contract. I was selling you, now I will be buying you. I will be buying from you at what price? This price. Simple technique, simple. Buying rate, ask rate becomes the buying rate means bid. I will be buy at this. Means now the customer is selling. Earlier the bank was selling now. Now as per cancellation, the customer is selling. Okay, so I can say the bank to buy, or I can see customer to sell. You can write like this because this is how the study has given. Okay, study is saying the customer to sell. Sometimes students get confused, sir, what does that mean? So you can read it in this way that the bank would buy at this price, or you can say now the customer will sell at this price. Sir, but the customer doesn't have that. I know the customer doesn't have that. We're just trying to knock off the entry. The debit done earlier, now we are just crediting so that the entry gets knocked down. You are accounting champ, right? So to cancel this thing, the bank will buy at this price and bank to sell at, this was the ask rate beta, this becomes bid rate, 65.200. Okay. So what is the difference? The calculator. Yeah. So 65.345 minus 65.29. Okay. So 0.055. So 0.055 is per Swiss franc multiplied by 25,000. So he will supposed to pay as rupees 1375 and your answer get complete. Better just, I feel good if you say clear, sir. I mean, that will be a motivation for a teacher, you know. Any doubts still here? Please let me know. I can always wait for a minute. You want me to repeat something? I can repeat. You want me to repeat the entire this thing, what you call answer? I can do that as well. That's really not a problem. But you have to just tell me, okay? Any number of students who are watching, you can just tell me that, sir, this is what we have understood or we have not understood. Simply. Clear, guys? Done? No doubts? Is it clear, guys? Should I wait? Should I repeat? Anything you want me to do that, I can do that. Just say yes or no. Clear, not clear, repeat, move ahead, anything you want to write. I'll assume. Fine. Oh, thank you so much, Naveen Prakash. Always been a savior. Thank you. Okay, beta. So this is what we have done right now. Let's move on to the next concept. Okay. Next concept means that when the cancellation is happening little earlier. Okay. Early cancellation means that the contract was for, let's say it happened on the 1st of January, okay, 1st January, and it was supposed to close at 31st March, okay. You are not coming on this date, you are coming little earlier, maybe let's say 1 month, 2 months, 2.5 months, whatever, not a problem. When the earlier cancellation shall take place, okay, the cancellation is happening little earlier, what you need to do, that we have to see. Okay, Beta, let me tell you one thing before we proceed further. There is a very important concept of the exchange margin, which I have taught you in the first class, that you need to add or reduce from the purchase or sale transaction. Sir, we have forgotten. No problem. We have forgotten. Yes. I'll give you a very simple way out to remember it. Please, sir, tell me. Beta, have you heard of a metal called as brass? Yes, sir. We have seen that. Okay, brass item are there in our home. It's a metal. Yeah. So you can learn with the help of this brass. Okay. When you are buying the currency, okay, you will reduce the exchange margin. Okay, this is one thing. And add the exchange margin when you are selling the currency. Clear? Simple. So this S stand for me, Sushant, because I have given you this code. Okay, so this is my trademark. So trademark is generally over here, right? Above the number, I put the trademark here. Okay, so that's my trademark. Okay, on a funny side. Okay, so when you're buying the currency, just reduce the exchange margin, and if you are selling the currency, just add the exchange margin. I hope this is clear, beta. Okay, so just write that for your solving the questions that will be used by you in the going forward. Okay, yeah. What is bank buying from the interbank? See, beta, Sairam, I told you to be very honest that the role of interbank will come only and only when you are making early delivery, okay, or you're doing a after due date cancellation, okay. When the things are happening within the purview, okay, within that, so we are generally not doing that. Calculation of the cancellation charges is far different from the swap differences. Okay, Saina? Although very good question, I mean, no doubt, master, excellent question. But the thing is that sometimes, most of the time, students always try to think from the perspective of the interbank as well. So the role of interbank will come only and only when there is an early delivery. Okay. Otherwise, even if the bank is having some interbank arrangements, it is not relevant from the quotient perspective. The calculation of cancellation charge is different from the swap differences. So you are humbly requested not to correlate both of them because both of them are different concepts. Okay, clear? Now, so now as you have heard that the concept of exchange margin is quite important. So remember that brass, the trademark of mine, so that you can do that. If you want to go for that logic, sir, why it is added, why it is reduced, you are again humbly requested to refer to my class number 1 and class number 2 again. Okay, guys. Now, when the cancellation is happening earlier, okay, it could be possible that you are canceling, okay, a forward contract can be cancelled before due date. Okay, so if that is the case, what you have to do is the cancellation shall be at the opposite rate, okay, of original contract. Opposite rate, okay. If it was a ask rate, you'll apply the bid rate. If it was a bid rate, you'll apply the ask rate. Simply, okay. So a forward contract can be cancelled before the due date. The cancellation shall be at the opposite rate of the original contract. Okay. It is not over yet. See carefully. That synchronizes with the original forward contract. Sir, abhi tak to it was clear, opposite it. Now that you have written something in yellow, this is not clear, sir. That could be your thought process. This bit I will able to explain you only with the help of the example which I will be explaining you. For the time being, you can understand that let's say we have done a 3 months agreement. Okay, it was a 3 months agreement. A person came after 2 months that I want to do that. Okay, so it says we can do the cancellation which synchronized with the original means when it was actually due, then only we will take up this. So please give us the example. We will not able to understand. I know that. I know. The earlier one was clear. Yes. I gave you 2 forward rates over there just to confuse you. Yes, sir. We are clear. Please, sir, explain this one. Okay. Chalo. So let's take it over here. Example. Okay. Let's take an example. It's a 3 months forward contract. 1st January it started till 31st March. It has to be obliged. That is why it's a forward contract. Okay. This is a bank. This is a customer. Okay. The bank wants to buy. Now I'm taking a different data because earlier I used the sell. Okay. The bank wants to buy. He must be an exporter. Okay. He must be an exporter because if he exports, he gets the foreign currency and he will sell it to the bank. So the bank is buying, the exporter is selling it to him. Clear? Okay. What? Australian dollar, 1 lakh. This I'm using all your study examples. Okay. The illustration which is given in our study. So Australian dollars, 1 lakh at the rate of 47.25. Now understood? The bank will be buying 1 lakh Australian dollars from the exporter. Okay. Let's name them Rahul. Okay. They will be buying this thing. Now Rahul came after 2 months. Okay. 2 months later, he requested cancellation. Okay. He requested cancellation. Clear? Clear, sir. Now, first of all, you see what is this rate? Is it a bid rate or ask rate? Sir, I am a customer, I am selling, and bank is buying. Bank buys at the bid rate. Okay, it's a bid rate. Yes. So he requested for cancellation. So we went to the forward market and see what are the rates which are going on. Spot rate, okay, which the study has given, is 47.30 and say 35. Okay, and 1 month forward is 47.45 and 47.52. Clear? Now better see your notebook that where you have written the concept of synchronization. What does synchronizes means? Okay, this very brilliant student of mine, Saira, was asking, sir, what if the bank is buying from the interbank? Now this will answer your this thing. In case the thing is happening on the before the due date, the cancellation is happening before the due date, Saira. You remember anything which is the uncertainty is always be a problem for the bank. If something is happening on the due date, the bank can manage their position. They can have a fresh position from that date. That's not a problem. If something is happening before the due date, then it's a problem. So bank says synchronize with that. Okay, so how would they synchronize? They said the original contract was for 47.25. We gave the bid rate. Now the contract should synchronize with that. He came after 2 months, okay, 1 month earlier. So he says now we will take 1 month forward rate so that it synchronized with the original contract. Okay, it synchronized with the original contract. So earlier it was a bid rate. Okay, earlier it was a bid rate. Now it will be ask rates. Clear, beta, everyone? A presentation I'll show you. Nothing to worry. Is it clear till now? Earlier, I told you the cancellation was on the due date. So interbank there was no problem that bank can manage the position. Cancellation or early delivery. In the both cases, we have to do that. In early delivery, we have to calculate two things: swap difference and interest on outlay or inflow of the funds. Here, we are supposed to calculate only cancellation charge. So, sir, is it quite easy? Yeah, it's easy. You have to just do this thing. You get 4 marks for that. But again, I don't know. Examiner can give you 8 marks, 2 marks, 5 marks. I don't know. But generally, when cancellation comes, it comes for 4 marks, and you can get it within 2 minutes of time. Okay, yes, sir. So presentation, how to do that? Yeah, I'll show you the presentation. So you would say the earlier was this thing. Okay, any doubts? Okay, so AOD, AOD to be bought under original contract. Okay, at 47.25. Okay, on cancellation, it will be sold to him. Okay, at what price it will be sold to him? Sir, it was bid rate earlier, now it will be ask rate at the rate of 47.52. What's the difference? I think 0.25 and 52 will be 0.27. ठीक है ना? थोड़ा untidy. Just I'm writing it again. So I think 27 per AUD. Total cancellation charges easy, because 0.27 into 1 lakh will become 27,000 rupees. Easy. No doubts, guys? Clear हो रहा है? It's very simple. It's very simple. When I was in SFM, when I was in CA final, SFM was not there. It was MAFA, MAFA, similarly. So for this, I had made a chart on my study table, and I wrote that in the very simple words. And honestly, that day's remembrance I can correlate today as well. Yeah, there has been a lot of amendments. ऐसा नहीं कि there is no amendment. There has been amendment, but that will always work for you. If the time will allow us today, I will give you that summary for sure. Okay, or otherwise I'll share with you in the next class. What's the big deal? Okay, clear? So any doubts still here? Let me know. No doubts, guys? Shall we move ahead? Okay, so what we have done as of now, we have done the cancellation on due date and cancellation on the earlier date. Okay, early cancellation we have done. If there will be a late cancellation, okay, third point. I'm going to the third one now. C part, if there will be a late cancellation, okay. So again, those provisions of automatic cancellation will apply. Okay, three things. One is the exchange difference, swap difference, the one you have done it in the day before yesterday's class. Okay, this you can say academic notes are given to you in the PPT. You can use them. Although again prepared it from your study material only. So that's not my copyright. That's the ICA's copyright. So you can use it from there as well. Okay, guys. So not much difference because this you have already covered. This you have already covered. This you have already covered. Okay. Now the third one. Now we can talk about another one. You have any doubts? You can just ask me, guys. Okay. I think we can do the assignment now. I think question. Huh? So we can do the assignment question. You have must have downloaded them. Okay. I've taken the printout of them. I will just share it with you. Okay. Just 1 second. We have to do. Yeah, this one. Okay. Is it visible to everyone, students? Question number 1 of the new assignment and question number 16 in totality, the questions that I've given. Thank you, Sairam. So in the exam, the first thing you have to see is whether the question is for delivery, whether the question is for cancellation, or whether the question is for extension. Clear? Whether the question is for delivery, if it's for a delivery, whether it is on a due date, it will not come because it's a simple one. So whether it's an early delivery or whether it's a late delivery. If it's a cancellation, whether it's a early cancellation or on the due date cancellation or a after due date cancellation. And extension, though I have not taught you, so why should I ask you right now? I will ask you little bit. Okay, how can I ask? Because that I have not taught you, right? So let's do this question. These are good questions. You can practice them at the time of your revision. That will cover up all of your concepts. This is what I have done. I mean, obviously, you will be preparing more questions as far as these things are concerned, but still, this will at least give you a good revision before the examination. Okay. So on 19th January, a bank entered into a forward contract with a customer for a forward sale of $7,000. And the delivery will take place on the 20th of March at the rate of 46.67. On the same date, it covered the position by buying the forward from the market at 46.65. So Sairam's interbank has come, but again we will see is it relevant or not. Okay. On 19th February, the bank approaches the bank and requests for the early delivery of the US dollars. Okay, sir. Early delivery. I think this we have covered or not? This I think we have covered because this is a buying one, right? Yeah, I think this we have covered. Sorry. Wait, Mega, this is an early delivery question, so we have already covered. Sorry. So let me take you to the next one. Huh? Yeah. 17 was that. Yeah. Thank you for your patience. Yeah, Swiss francs. This is a very good question, Beta. Very, very important question from the examination because it involves, yeah, it is done. Thank you, Navi. So nice of you. It is an important question because of the fact that, you will using a concept of cross rates here. Although I've told you in the starting itself, in the exam, you might not be able to identify it little earlier. I tell you that. Okay. So let's start doing it. A bank enters into a forward purchase TT covering an export bill for the Swiss francs 1 lakh at rupees 32.40 on 25th of April and covered itself the same delivery in the local interbank market as 42. So even if it is not clear that what the bank is doing, so they are buying something at this, so they are selling something at this. Obviously, bank will not take up any loss. Okay. On 25th March, I think 1 month earlier, the exporter sought for a cancellation of the contract as the bill of the tenure changed. So he's only going for the cancellation, guys. Okay. So no extension, only cancellation and early cancellation. So read your notes. Read your notes. What does early cancellation means? It will be cancelled on the date of the original contract and synchronizes with the original contract. You remember I had written in the yellow color, synchronizes with the original contract. So if he has come 1 month earlier, we will take the 1 month rate. Okay, clear? Now see. Okay, sir, where are we? Beta, we are in India. Okay, sir. This is the bank which is in India and they want to buy 1 lakh Swiss franc at the rate of 32.40. Okay, they are coming 1 month earlier, so it should synchronize with that. So if they are buying, okay, if they are buying, beta, they're buying, it must be the bid rates. So now they will have to, bid rate is not clear, I'll explain. Okay, I hope everybody has a question with them, right? Anybody who's not having the question, they've had a problem to download, you can let me know. Okay, so let's move to the forward portion so that we can calculate. Okay, you have just 1 second. It doesn't have. ना ना वो फाइल बस जस्ट 1 सेकेंड, उसमें पेज नहीं था ना लिखने के लिए, बस पेज डाल रहा हूँ, 1 सेकेंड. हाँ सर, लाइव कर दो आप, बस मैं दिखा रहा हूँ बच्चों को. बस ओके, 1 सेकेंड. Okay. Okay, students. Sorry for the delay. Okay. So this is the question. Let's start solving it. Okay. It wasn't having that paper, to write. So that's why I was just got busy in scheduling that solution. Okay. Now, this is a bank and they want to buy from the customer what? Swiss franc 1 lakh, I think, at the rate of 32.40. Okay, this is happening on 25th of April. Customer came 1 month earlier. Okay, now since it's a case of early cancellation, cancellation charges will be paid by the customer. Okay, as per the rate that synchronizes with the original contract. With original contract. Okay, so even if he is coming 1 month earlier, we will calculate the cancellation charges based on the 1 month forward. Okay, so I can write forward rate is required. Now, which one, beta? Bid or ask? So this was the bank was buying. Okay, earlier bank was buying, and the bank buys at what price? I mean, bid rate or ask rate? They take the bid rate. So to cancel that, the opposite will be there. Okay, opposite rate will be there. Means the ask rate. So we need, what do we need? We need 1 month forward ask rate. But beta, which one? Very carefully, rupees per Swiss franc. Sir, why Swiss franc? Sir, why not this thing? I like this, sir. No. Sir, please take this one. No, beta. Why, sir? Beta, again, class number 1. What is the base currency? Oh, okay, sir, base currency is SF. Yes. If you keep the base currency in the denominator, like students was wanted to, learn in this manner in the first class. So if you want to keep that, it becomes easier. The base currency same, you tend to multiply. Clear, clear, sir. So we don't need the SF by INR. We will be taking rupees per SF. Okay, okay, sir. Is it given to you? No, sir. What is given to you, sir? We are given Swiss franc per dollar, US dollar, and we are given the, what is the other one? Swiss franc dollar per rupees. Okay, so you are given dollar per INR. So you don't have a direct rupee per Swiss franc. So you will be using cross rates. Okay. The question that we are doing that came in your very recent examination. Okay. So how can we apply the cross rates better? Let's start doing it. We need ask rupee by SF. So it has to be ask rupee by dollar into ask dollar by SF, so that it gets cancelled out and you can get your answer. Okay. Is it given? Yes, sir. It is given to us. Is it given? No, sir. We are given Swiss franc per dollar. We don't have dollar per Swiss franc. So what we can do, what we studied in the second class, this is equals to ask rupee by dollar into 1 by bid of, see carefully this thing, SF by dollar. Okay, beta, have you noted it down? Has everybody noted it down? Clear? Okay. I am taking you to the main question now. So how do you do that? Okay. See. So as we know that we want to do this ask rupee by SF as ask rupee by dollar, which is given to us, and into ask dollar by SF. so that it gets cancelled out. So what we have done is we have done it ask rupee by dollar into 1 by bid of SF by dollars. Okay, so do we have this rate? Yes, sir. Acha, which rate? Not the spot rate, but the forward rate. Because this is a case of early cancellation. Okay, early cancellation. Clear? Yes, sir. So do we have ask 1 month forward rate? Okay, this is a 1 month forward rate. Bhulna nahi, don't forget please. Okay, 1 month dollar rupee per dollar. ठीक है sir. So this is the one. Okay, 1 month forward. Clear sir? अच्छा, अब there is one problem. Sir, what? You need to incorporate the exchange margin also on buying and selling. Fine, sir. Can we do that? Yes, sir. Okay, first of all, tell me which rate are we taking? Sir, this is an ask rate. So this is an ask rate which is 49.4455. Okay, okay, sir. And you have to incorporate the exchange margin in this, but before you need to know the 1 month premium. Yes, sir. So if this is an ask, this is the ask premium. So this will be 0.4200, adding the forward premium to that. Clear everyone? Yes, sir. It comes out to be 49.4455 plus 0.42. 49.8655. Okay. Exchange margin. Okay. Added or subtracted, guys? Brass. We are buying. The bank is selling. We are buying. Okay. That is the thing. When you buy the currency, you reduce it. When you are selling the currency, then you add the then you add the exchange margin. Okay. So ask means selling. So you have to add the exchange margin. So add at the rate of 0.10%. Is it clear or not? If this brass is not clear, then refer class number 1. Or otherwise you want to remember like that, you can do that. Okay. Ask, we are calculating ask. It's a selling rate. So if it is selling, you add the exchange margin. If you are buying, means bid rate, then you have to reduce the exchange. This will come in today's class only. This will come. Okay. So can we add the exchange margin 0.1%? So that will be 0.049 plus 49.8655. Achha, why should we do it here? Because we have to do it for both buying and selling. So we can do this little later. First, we can do this thing. Ek minute, bata do. We will be adding that. Don't worry. Okay, we'll be adding that only. Aisa nahi hai that I am just skipping that. So this is the rate which is there, 49.8655. Let's do it for this rate as well, so that we can calculate the exchange margin for totality. Into 1 by bid. Okay, bid means left hand side of Swiss franc plus per dollars. Swiss franc per dollar. Sir, already a forward rate is given. We don't need to add the premium. Clear? Sir, can you explain this cross rates again, because we just got confused with the exchange margin? Okay, fine. You have to calculate ask rupee by Swiss franc. Sir, this is clear. This one is also clear? Yes, sir, this one is also. Okay. So the ask rupee per dollar which I have taken, it was given to me by the examiner in this manner. This manner means 49.4455, I had to add the premium over here. 1 month premium, because he came 1 month earlier. 1 month earlier. So I just took 1 month premium, so that it synchronizes with the original contract. Original contract is on 25th of April. I have synchronized with that 25th April. So I've taken ask rate directly, the right hand side rate, not the left hand side rate, but the right hand side. Clear till here? Yes, sir. Now, one by bid. Bid means the left hand side. SF plus SF per dollars. So this is SF plus per dollars. 1 month forward rate. So 1 month is this directly given. I am not supposed to add any premium on that. Sir, how do you know? Because you can see 1.5076 and 1.5150, 5250, 5415. The premium is already added in there. I don't need to make any further calculation. Is it clear? Yes, sir. So right over here, 1.5150. So once I will calculate this, then I will incorporate the exchange margin. Otherwise, क्या करना पड़ता? We have to apply the exchange margin here also and here also. इससे better है कि let's do the calculation first and last में we can apply. So guys, is it clear or not? Okay, these are very important. I'm now taking to the next so that it becomes more legible. Okay, clear? 49.8655 है ना? 8655. 8655, 8655. Done. You can see your assignment. This value is taken simply directly, no change on that. So 49.8655 divided by 1.5150. So divided by 1.5150. 32.914. Although this is a rate which is without exchange margin. Okay. Now apply brass. So if we are selling, we have to add the exchange margin. Okay. So just add the exchange margin. So iska 0.1 percentage. I was doing it for here, then I thought iska bhi karna padega, so we can do it directly for the total. So that will be 0.0329. 32.914. Okay, so that comes out to be 32.9470, or let's say 74. Okay, so 32.914 plus 0.1 percentage. So 32.9469. Okay. Nine four seven zero. So 70. 73. Okay. Clear, guys? This rate is clear. 32.9470. Now the question is just a 2 minutes past every question. So calculation of cancellation charges. Okay. So original was to buy. Okay. Clear? Original contract was to buy from the customer $1 lakh. Okay. Now, now to cancel sell to the customer. Little confusing but not tough. Okay. So original किस rate पे था? If you remember, so sell 1 lakh at the rate of 32.40, the rate which was given to us in the starting itself. You remember the very first line? Contracted rate which was given to us. Now you can buy 1 lakh at the rate of 32.9470. Calculated rate with the help of cross rates. So this will come out to be 947 minus 32.4. 0.547. Okay. So into 1 lakh. So you will have to pay rupees 5470. 00. ठीक है बेटा, is it done? No problem. Clear? No doubts? So I hope you are able to do this kind of working in the exam. Again, I've been telling you, beta, the first and the second class was very conceptual. I asked you to calculate the bid rate, ask rate, cross rates, broken period, forward period determination. All these are required in your main examination questions. You know, that is the most relevant. Clear? No doubts? So can we move on to the next thing now? Okay. If there is any doubts, let me know. Otherwise, I can move to the extension. Okay. Now the third one, sorry, we have done it. Number 1, delivery. Number 2, cancellation. And now we are doing the extension. This also will have 3 types, just the way you had the other 2. Okay. So for the extension, you have 3 things over here, just like the way you had it over there. On due date, early extension, late extension. Okay, so we'll be covering up the first one, which is the extension on the due date. Clear? On the due date. So shall we move? No doubts? Bacho? No doubts? Okay. So when the extension is on the due date, okay, when the extension is on due date, again, right, what you have to do it in the exam. A, extension on due date. Again, Sairam's question, sir, any problem with the interbank? No, why will there be any problem? Somebody made a contract on 1st January that he will be buying or selling whatever, something on 31st of March. Okay, clear? On 31st of March, he came on the due date and said, the things are not happening the way it is. I want to extend for 3 months. The bank says, okay, not a problem. Not a problem. So what you can do is you can cancel first, okay? Cancel first at spot rate. No surprise factor because he came on the due date. So cancel first at the spot rate and then rebook at forward rate. Clear? No, sir. Abhi kuch karwaye nahi. How will that be clear? Okay. Extension on the due date means that first you will cancel the original contract so that the interbank that he must have done, that also gets cancelled out. And then you rebook at a new forward rate for which he wants to extend. If he wants to extend for 1 month, take 1 month forward rate. If you want to extend for 2 months, take the 2 months forward rate and so on. Okay? Is it clear? Yes. So write this. This is important. I'll discuss an example with you. Nothing to worry. Just write this. Okay? Okay, so let's share an example on this. Example, this is a bank. Okay, this is a bank. He wants to buy, what he wants to buy? Let's say $1,50,000 at the rate of 72.52. Okay, originally he wants to buy at this price. Okay, this is a bank and he wants to buy from this customer $1,50,000 at the rate of 72.52. Okay, so bank makes an interbank with another bank. So if he is buying at 72.52, he must be selling at higher rate. So let's say he wants to sell at 72.60. Okay. Now he comes extend the contract for 1 month. Okay, he wants to extend the contract for 1 month. Okay, simple. What rates you will be looking at? Okay, you will be looking at, let's say that day the spot rates are given to you as 72.72, 72.68, and 1 month forward is also given to you. Okay, so let's say 72.77 and 72.70. Any rates that you can. Okay. So what you will be doing on this? That's an important thing. Is it clear till now? No doubts? And you also have the exchange margin. Now can I incorporate this exchange margin? On buying and selling. Okay. Be careful, what I have written is not correct. Okay. Some mistake is there. No, it's not a mistake. It's the examiner's trick to know that whether you understand forex or not. Can you find that trick? Should I give you a minute? Can you find that trick? It's your study material question. Couldn't find it? Okay. But these, as I told you in the exam, you can, the rates which are given to you, it could be in quotes or it could be in symbols. Sometimes examiner confuses you with opposite rates. Can this be possible that the bank is buying at 72.72 and selling at 72.68? No, bank will never face a loss. So if this is given, it means you have to correct it in the exam as 72.68 and 72.72. Got the point? Sir, अब क्या क्या याद रखें? What all things we do you remember? Yes, there. That is the reason that there are chances that you lose marks in your SFM exam because you believe that this must be the rates. So very good try, Naveen. Very nice. Very nice. Proud of you. Very nice. Okay. So we have to correct that. Okay, sir. This is clear? Yes, sir. So now what we need to do is, first we need to first we have to do the cancellation. Okay. So let's do the cancellation first. So this is the correct rate, 72.68, 72.72. He was buying at earlier. Okay. So original contract was for buy, that is bid rates. So for cancellation, you need to have the opposite. So you need to do the spot selling rate. Earlier you were buying, up to now you're a champion, right? Earlier you were buying, now you are selling. Okay. And you are selling at the correct rate, which is 72.70, not 68. The bank will never incur their loss. Okay, the bank will never incur their loss. The rates are given in the wrong manner. So you have to correct that at in the exam. Firstly, you have to see whether the codes are given to you, whether symbols are given to you. Mostly they give you symbol, mostly, but again, I don't know. So if it is symbol, whether it is given correctly or it is the rates are given the adapted manner, the rates ulte diye, the one which is not the correct. Okay, guys, it is clear. So spot selling rate at 72.72, you will have to add brass selling hai, so you have to add. So you will add exchange margin at the rate of 0.10%. Okay. Shall I write it directly? So when you add 72.72 plus 0.1%. So 72.79. Clear? So earlier a bank was buying at this thing, they will sell at this. Okay. So selling rate is this, buy rate original. Okay. Original is 72.52. Clear? So minus 72.52. So the difference comes out to be 0.2727. Clear, guys? Into 1,50,000. So this is your cancellation charges. Done? Any doubts, guys? Okay, clear till here? Okay, so now this is the first step. Sir, you have not done anything new. Yes. Sir, you taught us cancellation. Yes. Sir, you have done the same step. Absolutely correct. If this is coming to your mind that I have done that same step, so you are absolutely correct. Okay, you're absolutely correct. I have not done anything new as of now. Now we will be doing that. Once the cancellation is done, we have to rebook and rebook at the new rate. Clear, beta? Sure. So this is cancellations clear? Okay, can I rub this? Rebooking of the fresh contract. Okay, rebooking of the fresh contract. Now, at what price they will be rebooking, beta? Originally, it was a buy, so bid rates. So obviously, again, it will be the bid rates. Which rate will it be? Okay, 1 month forward rate. Clear or not? The rates did I give you? This one. Okay, so 72.70 and 72.70. So earlier was the bid rate, so now also it will be the bid rate. So bid rate will be 72.70, and now the brass means since it's a bid rate, you will reduce the exchange margin. Okay, or you can also round off, not a problem, in the exam as 72.627. Clear, guys? No other thing is required in the exam. This is what you have to do it when it's an extension on the due date. Okay, guys, any doubts still here? I hope this is understandable. This is the new thing that I've done. This one on your this side. The cancellation you already knew. If it is on the due date, okay, then you cancel it with the spot rate. The only thing you have to incorporate is the exchange margin. Okay, okay, beta. Now we have already completed the extension on the due date. We will do extension before the due date, and then we can end it. End for the break, not the total session. We can have a break at 9 o'clock approximately. Okay. So shall I remove this? Okay. So now B concept. Extension before due date. Okay, so what steps you need to do? Steps, first step is basically you need to have the original contract, okay, be cancelled at relevant forward rate. Now the study has given relevant forward rate. What does relevant means? The actual one, okay? The actual one, okay? And step number 2, rebook at current forward rate of forward period. Sir, we have understood the step number 1, obviously, because you have already done this earlier. Sir, we did not understand step number 2. Can you explain that? Yes. Sir, can you explain with the help of an example? Absolutely. Have you written this? Yes. Should we do the example? Yes. Okay. So extension before the due date. So let's take an example that this is a bank. Okay. He wants to buy $50,000, okay, from a customer at the rate of 69.60 in 3 months time. Okay, so simple thing, he made a contract on say 1st January. On 31st March, he's supposed to buy $50,000 from this customer. The bank wants to buy. Okay, and again he wants to sell it in the interbank. Let's take an example that he is giving you at 70.15. Let's take an example. Okay, now this customer comes to them, okay, and wants to make an extension to 2 months. But he came after 2 months. Okay, let me write like this. He came in 2 months to extend the contract okay. So let's take an example that the contract took place on 1st January. Okay, he came on 28th February. Okay, that I want to do it for another 2 months. Okay, now that is the thing. So let's take an example. The examiner is giving you a spot rate, okay, of say 69.13 and 69.1. They are also giving you a spot for March, thana, so April and May. January was there, right? With April and May, yeah. So spot for April, so they are giving you 69.23 and 24, and spot for May 69.63 and 64. This is what the scenario is as of now. I just repeat again a very, very simple one, nothing much technical, very simple. The original contract was for 3 months. He came on 1st January that I will be selling you, me as a customer will be selling you $50,000. The bank will be buying $50,000 from the customer. He came in 2 months that he wants to extend the contract for another 2 months. That means he wants to go till 31st of May. The original contract is for 31st of March. So April and May. He wants to extend it for another 31st May. The spot rate is given to you. The forward rates are also given to you in the exam in the same manner. Are they given it correctly? Yes, sir. Any disruptions in the rate? No. So rates are absolutely fine. Okay. How do you do that? So what we had written it there, step number 1, that will be a cancellation. Okay, first is the cancellation of the original contract. Okay, so you buy at same 69.60, okay, and sell at what rate? What rate? What should we sell at? Forward rate? Exactly the same thing that we did in the cancellation before the due date. So what did I write in yellow? That synchronizes with the original contract. Okay. Sorry. So to synchronize that, you need to have that March and April. Now this is fine. Sorry. Okay. So it was closing at 31st March. So it synchronizes with this. So he was buying at this price, which is the bid rate, and they will cancel this contract by taking the ask rate. Got it? When you frame the example yourself, then you sometimes make a mistake. Take it as March and take it as April. So what we studied when we were studying about the cancellation before the due date, that even if you're coming before due date, we will take the rate which will be synchronizes with the original forward rate, the exact rate. Okay, the date at which the originally contract was getting over, which is the March. Okay, so here the bank is buying, means the rates are bid rate. They will cancel at the 1 month forward rate on the opposite rate, that is the ask rate, so which is 69.24. Is it clear, guys? Okay, buy at this, sell at this. You will be adding the exchange margin to this. Okay, this rate. Ask rate is 69.24. Now this is selling one. Okay, so as per BRASS, BRASS, you have to add the exchange margin at the rate of 0.10%. Plus 0.1%. $69.30. Okay, so 69.30. So 0.30 into 50,000 is what we are supposed to pay it to be paid by the customer. Okay, so 0.3 into 50,000, 15,000 rupees. Clear? See, nothing as of now new concept has been taught to you. The concept of cancellation is applied over here. If it is on the due date, then spot say you knock off the entry and done. If it is before due date, then you have to synchronize this with the original date of the completion of the contract. Same concept. It is not over because it is just the step number 1 that we have done. We will be doing the step number 2 as well. Okay, beta? Sure. So for step number 2, what you need to do is simply you have to rebook the new contract. And can you tell me the rate at which you can do that? Okay, can you take up that rate? Step number 2. Fresh contract rate, sir, very simple. If it was earlier 69.60, it was a bid rate. So for April, this will be the rate. That is 69.60. Okay, yes, sir. Is it a buying rate? Is it a selling rate? Sir, this is a buying rate, yes. So you will reduce the exchange margin as well. And the net will be this. 69.56. That's it. Full marks. No problem. Okay, guys? No doubts? So again, I'm telling you that if you do the cancellation of the contract properly, this is what I taught you in today's class, then you will never have a problem. In the last class, I studied with you the concept of early delivery. That was wholesale a very, very different concept. In today's class, I have taught you the concept of cancellation, which is earlier cancellation, and due date cancellation. After due date, automatic cancellation will apply. You don't have to do much on that because the cancellation is already done. So you have to just calculate the various rates over. Clear, guys? Okay. We have about 12 minutes before we go for the break. Let's do the assignment question number 2, and we can then end this concept. Okay, clear? Yeah. So this is what we'll do before break, and then we can go for the break. November 2010 question is there. Okay. You must have received the assignment, but still I'll study it for you for about 2-3 minutes. An importer requests his bank to extend. Okay. In the very first line itself, they are saying that they're requesting it to extend the forward contract for US dollars 20,000, which is due for maturity on 30th October, and for how much term? For a period of 3 months. So means, did he come on the due date or did he come earlier? Can somebody understand that? Is it the extension on the due date or earlier due date? But if you don't understand this, the examiner's thought process, how will you proceed in the exam? Read it once again. The importer requests his bank to extend the forward contract which is due for maturity on 30th October. Which is due, होने वाला है, which is due. Okay, it means he came before the due date. Okay, it means he came before the due date, which is due for maturity on 30th October. He did not say that which is due for maturity today. So it says which is due for that. So it means he's coming for the early cancellation. And early cancellation means that it synchronizes with the original date, that is the forward. Clear, guys? He agrees to pay the required margin for such extension. The contract rate is this. The US dollars quoted on 30th October is spot and 3 months PM in percentage form. The margin money for buying is different and for selling is different. You need to compute the cost of the import in respect of the extension of the forward contract and rate of the new forward contract. 8 marks question. Okay. Shall we solve this so that we can go for the break? Or should I do it here only? Okay, I'll try to do it here only so that we can see the rates and all. Yeah, that becomes easier. Okay. So, beta, this is a bank. Okay, this is a customer. Okay, the original contract was that the bank will sell the dollars for him. Okay, and the customer will buy the dollars from him because he is an importer. When he imports something, he has to pay the money in foreign currency, and to pay that amount in foreign currency, he will have to buy the dollars from the bank. Okay, so original contract happened at what rate? $20,000 at the rate of 42.3. Clear, beta? Okay, so 20,000 at the rate of 42.32. That was the original. Now comes the next one, which synchronizes with that. It was a sell contract, means this must have been bid rate or ask rate. Please understand that if the bank is selling, they must have quoted you a ask rate, not the bid rate. Sir, why is it relevant in our questions? Sir, we don't understand this. Beta, this is relevant because whenever the cancellation is happening, it is on the opposite rate. If the bid was taken, take the ask rate. If the ask rate was taken, take the bid rate. Simple as that. Okay? Okay, sir. So this was a sell, means it was the ask rate. So now, are the rates fine? Yes, sir. Now the rates are. So take the bid rate. It was ask rate, take the bid rate. Sir, but without exchange margin. No, we have to take the exchange. Okay. So this was the original. Okay. So the opposite rate will be 41.50. And since it's a buying bid rate, so brass buying, so you have to reduce it. BRASS. So it's a buying rate, just reduce the exchange margin. Buying, you have to do, take 0.078. $41.468. Okay, beta? Clear? So 42.32 and 41.468. So original contract, $20,000 at the rate of 42.32. Okay. This was to sell the currency. Okay. Bank to sell dollars and customer to buy dollars. Okay. Now, opposite contract, bank to buy and customer to sell. And bank buys at the bid rate, okay, with exchange margin adjustment. Okay, so which was the original one, beta? Not 62, sorry, 40, some 42.30. 42, 41, sorry, 41, 468. Okay. $0.85. Okay. So charges ₹17,022. Very good, Naveen. Nice questions, answers that you're giving. Very nice. This is clear? Okay. Okay. Now B part, rate for the new forward contract. Okay. This is what you have to calculate now. ये बताना है. So shall we do it? You can see it from here only, so that it becomes convenient for you. Okay. So what should be the rate, beta? Sir, earlier was the bid rate or ask rate? Earlier was the ask rate as stated correctly by Naveen Prakash. Okay, earlier rate. So new rate will also be the ask rate because the contract is cancelled. Okay, the earlier one. Now the ask rate. Okay, sir. So ask rate means, sir, this rate. Yeah, but this is a 1 month forward. You have to take a 3 months forward. Means 3 months forward rate, which will be 41.52. Okay. Okay. Now this is a selling rate, so you will have to add or reduce. Add the exchange margin. 20%. Okay. With a premium also. Sorry, premium to likha. Just one second. Thank you, Naveen. Wow. At premium at the rate of ask me, it is 93%. Okay. And add exchange margin at the rate of 0.2. So Naveen Prakash ji is saying 41.9899, which is also stated by other 2 students as well. So I think he's absolutely correct. Thank you so much, Naveen. Your answer is absolutely correct. Okay, guys. So that ends our concept of the forward contract. Okay, students. So I think you have already taken care of all these things. Okay. And let me just clear all this. Yeah, so we are almost completion of this concept. Then we have to start again a very important concept. So last is beta the late extension. Okay, the extension which is happening on a later date. Now comes the concept that we have been deferring it since our last class, and trust me, trust the universe, it's very, very simple. Okay, automatic cancellation. And not only simple, this is very important as well, because it asks, the examiner asks you to calculate all the things which is required. Okay, so now see carefully. As per FEDI rule number 6, what is FEDI? Foreign Exchange Dealer Associations of India. Just for your GK knowledge purposes, exam mein thoda they will be asking. So the Foreign Exchange Dealer Association has rule number 6. Just you have rules under income tax, or let's say GST. They also have their rule. What does it say? A forward contract, the one which we have just added, which remains overdue. Overdue means either you did not sell the foreign currency or did not buy the foreign currency. Okay, without any instruction. Without any instruction means no communication came to the banker, because you consider yourself as a customer now. Okay, so you took a forward contract that you will be selling $1,000 to the bank. Okay, and you did not give any instruction, means no email, no phone calls, nothing. That whether you will be making an early delivery, you want to cancel it, or you want to extend it. No further things are there. From the customers, on or before the due date shall stand automatically cancelled within 3 working days. 3 working days means, for example, the contract was due on a Friday, just like today. Today is a Friday, 24th of December. Okay, so no communication came today till 6 p.m., the closing time of the banks. Okay, so they will not count Saturday and Sunday. They will count they will wait for you for Monday, Tuesday, and Wednesday. And after that, it will be an automatic cancellation. Okay, after the maturity. Clear? Very simple concept. Okay. Though customer is liable to pay the exchange difference arising there, but will not be entitled to for the profit resulting from this cancellation. You read with me in your last class that in the first example which I gave you for the early delivery, you remember, there was a loss and the customer had to pay the loss. In the second example which I gave you, the customer made a gain over there, made a gain of some amount, and he was not eligible for that. He made a profit on that and he became eligible for it. Okay. In this case, if there is no communication for the 3 days, okay, that will lead to the automatic cancellation. So is their time limit reduced? Yes. The time limit earlier was different. Now the time limit has reduced. So those students who have converted them from old to new, or who have their exam, this is the most amended one. So please check this. You can check your study materials. Okay. So for late delivery, so any profit that you will be having, you will not be eligible for that profit. Okay. For late delivery means the first one, and the extension after the due dates mentioned above the contract shall be treated as a fresh contract. And appropriate rates prevailing on site. Appropriate rate means we have just studied today. If it was a buying rate, then you will take the sell rate, and so on. Opposite. Okay. And it applicable as mentioned below. If there is a late delivery, the relevant spot rate prevailing on the date shall be applicable. Sir, what does it mean? Simple, beta. On Wednesday, the automatic cancellation happened. Yes, sir. Means 25th, 26th. So 27, 28, 29th of December, it becomes automatic cancellation. Okay. So you will take the rate on 30th December. The relevant prevailing spot rates will become applicable. So let's say you came on 30th December on Thursday. Let's say I want to extend. So that is the extension after the due date. In that case, the relevant forward rate for the period desirable shall be applicable. We have done all the examples in our previous class today. 2 hours almost we have spent on only this thing. So I'm sure this must be understandable to you, right? This must be understandable. So for the late delivery, the rate prevailing on such date shall be applicable, and extension after the due date, the relevant forward rate will be applicable. Because you are extended for, let's say, 2 months, okay? For 2 months, you came on 30th December. So now you'll be taking a rate for January, February. So 30th February is not there. So 28th or 29th February rate will be taken up from here. Okay? This is what in case of late delivery and extension after delivery. Okay, guys, clear? Any doubts? So as I've already mentioned earlier also, that any profit that you will be making on that, you will not be eligible for that profit. The one which is normally passed, in that case, it is not. Okay. Now, if you have your notebooks, please write down this important thing. Okay. That what are the cancellation charges shall be payable in case of late delivery and late cancellation. Okay. This I've already told you although, but again you can write. Cancellation charges. And late delivery. Number one, swap difference. We have studied in today's class the very first thing when we started. The very first thing. Okay? Swap difference, or you can say the swap loss. Rates, I don't need to tell you. Okay? The difference between the spot rate and the forward rate that you conducted because of the early delivery that the customer had done. Okay? Same thing. So covered earlier. Okay. Now, second thing is the interest on outlay of funds. We've covered this also. Okay, na? And the third and the new thing is the exchange difference. So this is also we have done. Yes, absolutely. We have already covered in our classes. Okay. So the difference between spot rate, okay, means offsetting rate, or you can say a cancellation rate. Okay. On the date of contract, after due date, or 3 working days whichever is earlier. Okay, so let's say he did not come on 24th of December today, he came on Monday. So 3 days has not passed, so it will not be a automatic cancellation. Okay, so the exchange difference will be the date on the contract after due date or 3 working days, whichever is earlier, and the original rate. So if you ask me, sir, what is the difference between what we have done it in the last 2 hours and this? The only difference is that you have to here take the day at what time did the customer arrive. If he came within 3 days, so you take those first, second, or third day. If he comes after 3 days, then whenever he comes, take the spot rate of that day. Okay, so these are the three things which are required. I'm just waiting for your queries. Just in case you have any queries, please do it. Okay, otherwise we can start with the new concept. No doubts, guys. So shall we move ahead? Hmm? No doubts? Sure. So these are the three things which are important from the examination, very, very important before you go for the examination. Okay, sure. Now comes the another important concept of hedging. Okay. But this you have already studied in your derivatives class. Okay. So I am taking a implied assumption that you are already clear with the concept. Okay. So this is our last concept. We will be ending this concept on the Monday's class, and we will try to do as much question as we can. But again, it is up to you that you need to practice a lot of things. A lot of students come to me and ask me, sir, from where I can do. See, books can be many, but I don't think that the kind of effort Bodo Studies had made in preparing a book called Practice Manual. Sir, we have not heard of this name. Yes, yes, you might not have heard of this name. It used to be for the old course. So, sir, what are we supposed to do with the old course? I know. See, there were some very, very excellent questions that was framed by Bodo Studies team, and now they have incorporated those questions in your new study method. Fine, sir. So just make sure that before you go for your examination, okay, before you approach your examination, you should do each and every question of that. Okay, I have selected few questions from there, and I will try to complete them in the today's class and tomorrow's class. But again, before I start with those questions directly, I will just um, clarify your conceptual doubts. Okay, okay. What does basically hedging means? Simple thing. These days, you are also hedging yourself against those Omicron, Delta, and Alpha, all those things. You are wearing a mask. When you ride a bike, you wear a helmet and you hedge yourself. When you are driving a car, you put a seat belt, you hedge yourself. So similarly, foreign currency is like that. Okay. You have to hedge your foreign currency so that there is not the reduction in the cash inflow or overpayment of the cash outflow. Sir, we did not understand once. See, beta, if you are an importer, okay, you will have to pay foreign currency. If foreign currency get higher, your payable will increase. Payable बढ़ जाएगा. You will have to pay more money. Other situation is good. Okay, so I mean that foreign currency gets lower and all those things. So that's fine. That's absolutely fine. Okay. So importer for the foreign currency gets lower, then it's fine. That's not a problem. For the exporter, okay, you have to pay. Sorry, you have to receive. You have to receive the foreign currency, and if the foreign currency get lower, your receivable will also get lower, unfortunately. Okay, so to hedge that, we are basically taking a lot of ways. Okay, in the exams, 5 wayouts they can ask you, and each of them is extremely important. 5. 2 are very simple to do because that's a straight calculation. Okay. Other 3 are little tricky, and out of the most trickiest, we will do one of them today. Hope so. Okay. Yeah, hope so because we have a lot of time. Okay. So, what all things can be asked? I can tell you. Okay. They will give you that either you will be an importer in the question or you will be the exporter in the question. Okay, so they will ask you that what will be the payable in case you are importer or receivable in case you are an exporter when you are taking no hedge. So simple calculation, nothing much to worry. Second, when you are taking a forward cover. So forward rate will be given, so you can very well know what is your payable or receivable in that. Simple. Third is the concept of money market hedge. Okay, I'll discuss on that. I'll discuss about this today. Don't worry. Number 4, with the help of options. Very, very important. Very tough sometimes. Why, sir? You have studied call options from others, sir. You have studied put option. Yes, sir. Sir, we know we are a champion of call and put. I know. I know. But call option buying gives you a right but not the obligation to buy a foreign currency. Now, which currency will you buy? Sir, obviously the foreign currency. Yeah. But that you have to see in the exam. Sir, you are scaring us. No, I'm not scaring you. I'm requesting you that before you come for the Monday's class, you should revise the options properly. What other sir has taught you about call options and put options. Because I will not be touching what is a call option, what is a put option. Because I know they have taught in a very nice manner, including inputs from Ashish sir as well. Okay. So I will not be covering it on Monday. I will directly be assuming that you know what's a call option, what's a put option. Okay, both buying and selling calls and puts. Okay, writing the calls and puts and holder of the calls and puts. So you should be known. So option will be a little more challenging that we'll be discussing on Monday, not today, don't. And the concept of futures. Okay, this will be a important and a difficult. The number of futures that we need to. You must have calculated the concept of hedge ratio. Yes or no? Hedge ratio, did you calculate it? You remember the formula? So similarly, that formula we will be using in this concept on Monday. So again, I'm requesting you, humbly requesting you, that before you come for Monday's class, if you really want to have a very good understanding of all this, because I'll be winding up the chapter that day. Okay? So you should be clear with all these concepts. Okay? So today, no hedge means no hedging was done. So it's a simple thing. Forward cover, we've already covered forward contract. Okay. Today we'll be doing money market hedge in about half an hour. I mean, we'll try to complete as much in this half an hour's time as we can, and then we can continue in the Monday's class. Okay. Assignment you already have, beta. This will be prevalent for your next class as well. The Monday's last class. Okay. So we will try to complete them as well, and we will try to take up few more questions just in case time allows us to do so. Okay, chale? Let's do quickly the concept of money market hedge. Chalo. But a money market hedge is little difficult to understand, but I will try to use some very simple examples and I will try to explain it to you. Okay. If you have any doubts in the previous sessions, classes, please do not hesitate. Your hesitation will create a problem for you. Okay. So it will not be a something which will be helpful to you. Okay. So hesitation will be your problem. Now, the thing is, what is money market hedge? First of all, before I forget, please write down something which I'm explaining you. I mean, not explaining you, I'm requesting you to do yourself. It's a very important theory question. What are the type of hedges? There are two types of hedges, internal and external. Okay. Study material has given it excellently. You don't need to refer any other book in your life. Study material has given that answer very, very brilliant. So there are two types of hedges. One is the internal hedge. One is the external hedge. Internal hedge means invoice in the home currency, and all those leading and lags. All these things are given to you. Please study them for theory. It is very important, very very important. Okay, theory, comes a lot of marks. So don't ignore that. And no other best way to study but to study from your study materials. Okay. So out of those two hedges, internal and external, this is called as an external hedge. Sir, what is an external hedge? Beta, the one which you do it while you are going out of your office. Sometimes you make an arrangement within your office itself so that you can able to protect yourself against the irradical movements of the foreign currency. But external hedge means you go outside and carry out this transaction. Okay, so you basically aim to protect against foreign transaction exposure. Sir, what is that? Beta, again, study material you have to refer. Oh, there are three type of exposures: transaction exposure, translation exposure, and economic exposure. Again, these three answers are also given in your study material. It is very, very important from your theory perspective. So please do not ignore them. Please write it. Otherwise, baad mein you will forget. Okay? That's just, I can request you. Otherwise, it's up to you. You want to study or not. Okay? So it is a protection against the transaction exposure. I will not be able to explain you theory because it is given in a very simple and lucid manner in the study material. So you can refer study material, you'll understand. Abhikili, you understand how to tackle with the money market hedge. Okay? So money market hedge beta is for both of them. Both of them means it is both for exporter as well as the importer. For both of them, it is there. Okay? So first we will do for let's say importer, then we can do it for exporter. Koi bhi ek you will understand, the other one you will understand automatically. Okay, so just to give you the revision of what we have done in the last 5 minutes, we have completed our forward contracts. Okay, delivery, cancellation, exchange. Now we are doing the hedging of the foreign currency. So the question can comes in 5 ways. One, the importer or exporter has not hedged the foreign currency. So everything is put on God's side. What will happen? Second, you have already taken a forward cover. So the rate on that date gets decided. Nothing else needs to be done. Number 3, you are taking up a money market hedge and you do the calculation earlier, whether you have to take the money market hedge or forward, all this thing. Because the examiner can give you 4 items or maybe 3 items, and out of that you have to select which one will be resulting in less cash outflow if you are an importer and more cash inflow if you are an exporter. So you have to give it your answer in the exam. Okay, this is how the examiners are asking. And the fourth one, options, selling a call or selling a put, or buying a call or buying a put. And fifth one is futures. So we are doing the first one, which is quite technical, which is a money market hedge. It's an external hedge. It's not an internal hedge. And it protects against the transaction exposure, not the translation exposure or the economic exposure. Transaction means the transaction which happens on a day-to-day basis, like a cash flow. Translation means the translation which are happening on a year-end basis. When you value your assets and liabilities, you must have been doing in your FR the consolidation of accounts. So you must have been doing over there. Okay. So money market hedge is used for both the importer as well as the exporter. We will try and study first for the importer. Okay, clear? Number 1, MMH for importer. Okay, so chalo. Now the customer comes on the left hand side from today's onwards. Okay, this is Rahul. Okay, he is an importer. Okay, means he's importing some goods and he wants to pay the currency. Okay, he is located in India, and there is another more guy, John, who is in USA, who is giving him the iPhones. Okay, he's selling iPhones, and he has to pay him US dollars, say 1,03,000. Okay, 3 months. Clear? Yes. Okay. He calls up John and he says, John, what is the US bank? Okay, let's take example, Citibank. Citibank has, in terms of deposits and borrowing. As I told you in the initial classes, there are two rates which are there. Okay, two rates are there. One is the rate at which a bank takes your money and take the deposits, and one is the borrowing rate, means you take their money and you have to pay the interest on that. Okay, sir. So he says that deposit rate are, let's say, 12% and 15%. And Rahul is in the bank who pays 6% as deposits and charges 15% as borrowing. Okay, they charges 6%. They pay 6% if you put your money over there, and 15% if you are borrowing from it. Okay. Now the spot rate. Now comes the main characters of this thing. Spot rate is, let's take an example, $1 is equals to 70 and 71. Okay, forward rate is 71 and 72. Okay, the kind of question that comes in the exam, they ask you which option is better. Okay, which option is better? Number one, forward, or number two, money market hedge. You are an importer. Okay, you are an importer, so you have to see what reduces your cash outflow to a lower level. By import करेंगे, payment करनी है. Will you be happy to pay higher amount? No, you want to save your amount. So you should be happy in your paying a lower amount. So the option which gives less cash outflow should be your selection. Done? No doubts? Okay. So what I have taught till now is that you have to calculate the MMH for the importer. Rahul is an importer who is in India. He has to pay 1,03,000 in 3 months to John, who is in USA, since he is selling iPhones to Rahul. Spot rate is 70, 71, and forward rate for 3 months. Okay, this is a 3 months forward rate is 71 and 72. Okay, you have to evaluate which option will be better, whether he should go for a forward rate or whether he should go for a money market hedging. Clear, guys? Yes, sir. So, better if he go for a forward rate, okay, I'll write it here. A. If we go for a forward rate, okay, if he goes for a forward rate, then what rate will he have to pay? Can you judge? Now it's easy. I will have to pay. I'm Rahul, okay? I will have to pay $1 lakh to John. So to pay him, I will have to buy from the bank. If I am buying, bank is selling, and the bank will sell at this rate. Up to you don't need to get any confusions on that. Clear? Abhi to spot rate liya. I will come to that forward. Okay? Clear? So if I am buying, bank is selling, bank will be selling at 71 rate spot. Then you said, no, I don't need it right now, sir. I need to pay it after 3 months. So I said, okay, fine. Spot rate is 70, 71, means bid is 70, ask is 71. Forward rate is bid is 71, ask is 70. So, okay, fine. So you will be required to pay under a forward rate as 1,03,000 into 72, and you will pay him how much amount? Oh, 74,16,000. Okay, clear? No doubts? Simple, straightforward. Now you have to see in B, how much are you paying in money market hedge? If it is lower, then you will prefer this. If it will be higher, then you'll prefer the one which is lower because you are an importer. Okay, beta, is it clear? I hope no doubts in there till now. Okay? Okay. So I hope you have written the forward rate. So can I rub the forward rate only? Okay. B, money market hedge. How to do that? Very simple. Beta, you have to make the payment. Okay, payment karoge na? You will have to pay the dollars. Making a payment is a liability. By making a payment after 3 months, apni books mein what we put? Is it an asset? Oh, we have to take the money. No, it's a liability. Okay, so you have to convert that liability into an investment. Sir, we did not understand. Abhi kuch samjhaya hi nahi. I have not even taught you anything. Is it clear what I've written? Yes. You know what is this? Yes, sir. This is a short form. Short form or what? PLI. Do you know these days the government is giving you a PLI incentive, production linked investment scheme? Yes, sir. So don't worry, I'm not here to teach you economics. That you know better than me. Okay? I'm here to teach you how to learn this concept. That means, it means if you have to make a payment, making a payment is a liability, make that liability is into an investment. Investment means as an asset. You can write it PLA also, PLI also, not a problem. Whatever is beneficial for you to learn. So if you have to make a payment, since you are importer, it's a liability. Convert that liability into an asset. Means convert that into an investment. Clear? Yes, sir. Kaise? Okay. First of all is that you can do one thing. What, sir? You can put, listen carefully. You have to pay to John after 3 months? Yes, sir. Okay. If you put your money in Citibank today means spot rate. If you put your money in Citibank today and tell Citibank that pay John after 3 months directly, will it be good? Yes, sir, absolutely. You go to the Citibank, okay? You go to the Citibank and say, I am giving you some amount. What is that some amount? I'll come to that. Just pay to John after 3 months. My tension gets over. My tension gets over. Okay. Citibank says, yeah, no problem at all, sir. But how much will you deposit today? Sir, obviously 1,03,000. No! You will not deposit 1,03,000 because if you put some money in Citibank today, you will earn 3 months interest on that. Are you imagining? You are not going anywhere, Baba. You are in India, you are remaining in India. You have Citibank branches in India? Yes, sir. So you go to Citibank, you said, I am giving you some amount. Abhi hum calculate karenge. We will calculate that amount. I am giving you some amount. You pay that amount after 3 months to John, who is in USA. My tension gets over today itself. I don't want to remember on that. Said, okay, fine, sir. So how much should I deposit today in Citibank? Okay. How much should I deposit? Okay. How much to be deposited today in Citibank so that it becomes 1,03,000 after 3 months? Yes, sir. Sir, deposit rate is 12% per annum, or we can say the rate is 3% per 3 months. So please deposit 103 divided by 1.03. So sir, deposit $1 lakh today in our account. We will give you 3 months interest and we will put that money directly into John's account. Your tension get over. I said, okay, fine. That's very simple. I will put 1 lakh rupees today. But from where will I get this 1 lakh? How did we get 1 lakh? Is it clear? Reverse working. With interest, I will get 1,03,000. 1,03,000 will go to directly into this John's account. Okay? This will go directly into John's account. After 3 months. But this is clear. I have to deposit 1 lakh. Now the thing is, from where Rahul will get this 1 lakh? Sir, obviously he will borrow. Absolutely. So Rahul will have to borrow this 1 lakh. Okay? Rahul to borrow 1 lakh today. So to borrow 1 lakh today, how much money does he require? Sir, dollar borrow karna hai na? We have to borrow dollar. Yes. So you will have to pay INR. You will sell INR to buy dollars. Why are we buying dollars? So that we can put the money in Citibank today and 3 months ke baad he will make the payment to John. Our tension gets over. Clear? No doubts? Okay. So he will deposit with the bank $1 lakh and he will take 1 lakh. How? By going to the bank. He said, I want to buy 1 lakh. It's okay. Bank says, you want to buy? I will sell. Okay. And if I sell, the rate will be 71. You are buying at the spot rate. Bank is selling at the spot rate. You are selling INR and you are buying dollars. You are selling INR, buying dollars. You are selling INR, buying dollars. Remember this. Okay. So how much money you are paying? You are paying into 71. That is, you are paying him 71 lakhs. You paid 71 lakhs and you got 1 lakh. Finish. Story finish. You paid him 71 lakhs, you get 1 lakh. Okay? You paid him 71 lakhs, you got $1. You took this $1, you deposit in the Citibank. After 3 months, make the payment to John. My tension gets over. Finish. But now, one last thing. From where will you get this 71 lakhs? Sir, obviously we will borrow it. Absolutely correct. You will borrow this dollars. Borrow this INR, this 71. From where? HDFC Bank. He gives you 6% on deposits. No, but it's lending 15% on borrow. Okay. So how much did you borrow? This is step number 1. This is step number 2 and number 3. Rahul borrowed 71 lakhs at the rate of 15%, but this is per annum, okay? Per annum. So how much did you end up paying, beta? 71 lakh ka 15% into 3 by 12. Okay, 71 lakh ka 15% into 3 by 12. Okay, so 2.66, so plus 71. So you end up paying them 73.6625. I hope everybody is clear from where did I get the amount. 71, I'll write it downstairs. 71 into 15% into 3 by 12. 73.6625. Okay? Any doubts, guys? No doubts? Clear? And just 1 second. Yeah. Clear? So, is it clear? I'm just holding that screen for 2 minutes because I have to rub all these things. Okay? You want to take a screenshot, you want to write it, up to you. Okay? Because we have some time. Okay, beta? Can I rub all this? Okay? Okay. Now see, as per money market hedge, the cash outflow was 71 lakh into 15% into 3 by 12. So it resulted at 73.66 something. I'll see. As per forward cover $73.6625. Therefore, money market hedge is a better hedging tool as it leads to lower cash outflow. Clear, guys? Thank you, Naveen. So nice of you guys. Writing no doubt, sir. Thank you. Clear? Before we end the class, we have about 5 minutes, okay? Sir will not join, I guess, today. Okay? Maybe he has some very important meetings. Okay, so just before we end, we have 5 minutes. I can give you the revision. What are the steps that we have done in case of the money market hedge? Okay, that will suffice purpose. Chalo. So, a revision of these steps. Required under, oops. My mother used to always scold me that when you have a bad handwriting, how can you clear your CA examinations? So I used to joke on a lighter side that might be the examiner did not understand my language. So he or she just gave me marks to pass. Okay, so that is just on lighter side. Make sure you doesn't do that. I have a bad handwriting since childhood. But this age can't be improvised, but make sure you are writing the answer legibly so the examiner can give you good marks. Okay, that was on the lighter side. You have to be legible, otherwise the examiner can deduct your marks. Okay, so you have to do the PLI government scheme. Okay, PLI scheme. Okay, what? You are an importer, you have to make the payment, it's a liability, you have to convert that as an asset. Liability, you have to convert that as an asset or investment, you can say. Okay, so what steps do you take, Peter? Step number one, since you are making an investment, you are investing the amount in foreign currency bank that matches with the maturity. Matches. Okay, that matches with maturity. So you deposited $1 lakh, so you know after 3 months it will become 1,03,000 after interest, and the person, that is Mr. John, will get that amount exactly. So okay, so very first thing is that you need to deposit, or you can say invest that amount of foreign currency in the foreign currency bank, investing the amount of foreign currency. Investing the amount in foreign currency, I would say, investing the amount in foreign currency that matches with maturity and amount. Second, to put that money in the bank, okay, to put that money in the bank, you calculate, you buy the foreign currency. Okay, money in bank means foreign currency bank. Convert home currency. In our example, it was INR, but in exam it could be anything. Convert home currency into foreign currency by buying at spot rate, by buying at spot rate. Okay, and to buy that, from where will you get that amount? Number 3, to buy foreign currency above, borrow the amount equivalent to the currency required, and compare the outflow, okay, after taking the impact of the interest, okay, after paying the interest on borrowed amount. Okay, beta. So this synchronizes with our, I think, class. Luckily, exactly 10 o'clock. Okay, sir, what if after these 3 months dollar was down, then what would be the treatment? But a dollar becomes down, how does it matter? Beta, just imagine yourself, Sairam, beta, you are depositing 1 lakh to that, okay, dollar you are putting, okay, so John is in US, okay, Citibank is also having their currency as US dollars. So how does it impacts to us? Okay, how does it impact to us? We bought the dollars today and we deposited in the bank. Now this value remains same or whatever. We bought it at 71 rate and we deposit at the bank. Now the bank will pay according to that. The depreciation of a currency matters to us, not to Citibank or John. Okay, the depreciation of any currency matters to us since we are an importer. It doesn't matter to John or Citibank. So what we are doing is we are doing in the all the work in the spot rate. Nothing is happening on future. So whatever is the price up and down, it really doesn't matter to us. We have already deposited 1 lakh to their account today so that after 3 months with the interest they can get that. Okay, it doesn't bother us anymore. Clear, beta Sarah? Just write clear so that I will be in a satisfied situation. Okay, and then we can end today's class. So I hope beta you like today's session. Okay, just leave your feedback, positive, negative, whatever, because we are not perfect. We always strive to make some or the other improvements in our work. Okay, and if that is clear, guys, so we can meet on Monday morning, same time, to have the wind up session from this topic, which is called as the Forex. We'll be covering up better futures, options, and money market hedge for the exporter. Okay, money market hedge for the exporter. We have done it for importer, the PLI, the short form I told you, we'll be doing for the exporter. Okay, beta. So I hope you will have a great time ahead. Enjoy your weekend, do study and revise derivatives before you come to the next class. Thank you so much to the entire Board of Studies team and to the IT support team as well, who have been our mentor as well as the moderator throughout this session. Thank you, everyone. Thank you to all the participants.